Over the course of the next two slides, I want to just give a little outlook on where we see the demand drivers for commercial real estate are in India. Given the economic background, a lot has been said about complexities and how things are shaping up. So largely three buckets of commercial real estate demand in India. The India-facing business, which represents the domestic economy, which is across broad sectors like banking, manufacturing, automobile, pharma, retail, real estate, etc. The second sector, which means a lot to this market here, which is the global technology work that happens in India. And then, of course, the flex offices, which is again, as Lee mentioned, now about 20% of the commercial real estate demand in India, which consumes both the India-facing business and the global technology work that happens in India. Now, if we look at the nuances, you also have to look at the background of what is happening to each of these sectors. The Indian economy, is a bright light in the global world today, where there are different headwinds which are faced, which a lot has been already spoken about. What we see of the India-facing business, and as per the numbers which came by, the India-facing business largely, they represent space take-up across the country, but a huge concentration is in Bombay, parts of NCR, of course, Bangalore, and so they are around the country. But the key indicators for the India-facing business, they constitute about 35% of all space take-up, which is the largest contribution in the last sort of 25 years as a bucket. So that's a huge move that the India-facing business, and that sort of talks about how the Indian economy is doing well. So there is going to be volume growth that I mentioned, and there is going to be a move towards quality. There's a general perception and maybe certain facts that the India-facing businesses are sitting in buildings, perhaps, and they will be moving towards quality spaces. So there's going to be a uptick in volume and a move towards quality. As I already mentioned, the Indian economy is growing at about 6.5% GDP, and it's likely to stay like that over the next 5 to 7 years. The other huge factor is that return to work in the India-facing business is 100%, and not just now, but over the last 12 to 18 months. So another big factor that. Corporate balance sheets are, clean. Banks have, cleaned up their books. So this is looking up really strong. And there is a smattering of this across the country, but a huge concentration between the NCR market and Bombay. The second bucket, which is the most important sort of demand driver for most tech markets, and Bangalore being the number one tech market, perhaps in Asia, perhaps minus North America in the world. So what are the drivers there? We see that the number of deals are going to increase. That is a reference to what Lee mentioned, that there are more companies that are likely to take up space. But the average deal size is likely to go down, given the fact that larger core tech firms are perhaps on the fence. Now, I'm going to talk a little bit about global technology work in India, and that's again segmented into three buckets. First is the services firms. So, the likes of TCS, IBM, Wipro, Cognizant. The second is the GCC work that happens out of India, and that would represent largely the real world economy. So banks, manufacturing companies, automobile companies. So example, Caterpillar, Cummins, JP Morgan Chase, where they are doing their global technology work. And then the third segment is the core technology work, the likes of Microsoft, Google, Amazon, etc. So there are three segments of demand within the global technology work that happens in India. Our sense is that the real world economy, the 7-Elevens of the world, the retail sector, the defense sector, which is doing global technology work out of India, they have a higher return to work that is pushed through by blue-collar workers out of North America or Europe who've always been in their manufacturing plants or in their wherever they are servicing their clients from. And that segment of work is, if you outlay back to what's happening in India, that segment of work is going to drive the demand. The services firms, are also one segment where these GCCs, or rather the real world economy firms, may take up space, right? And the return to work, as I mentioned here, within the real world economy, which will do technology work out from India. For example, JP Morgan Chase is mandating people to come to work far more, perhaps, than some peers in the traditional technology business. So that's one key trend that is emerging. And then, of course, a lot has been spoken about what are the key attributes of this space take-up. I think there are multiple complexities and hence multiple strategies to look at real estate planning. Key being climate change, ESG, diversity and inclusion, dispersion and hybrid. There's not one fit all. There are a lot of nuances, as Lee mentioned, but these are some of the things that will be represented. So you will see companies within the manufacturing sector, defense. It's broad-based and it's not core technology, whether they do GCC or they come via the services firms. The third segment, which is the flex office, I think given the uncertain environment, it will continue to be at play. It is a viable option, and I think it's gone beyond the proof of concept. It's a real solution today. And for multiple reasons, conventional offices will migrate a portion of their portfolio into managed offices. And of course, it's the convenience which is driving it. I think developers consume a lot of risk when they invest in projects, whether it's buying land, developing, constructing, and then taking the risk of leasing. I think managed players come in between the occupier and the developer to fix that gap, given the economic backdrop that we are in. But one of the key challenges, given the interest rate cycle that we are all aware globally, the way they have gone, so the capital that existed a few months back, even in India, we were trading at about 7% and now maybe at 9%. That's going to be a challenge for the growth of flex offices. So perhaps you may not see speculative signing happening as it was, maybe a couple of years back. I'm just going to take 2 more minutes and give a backdrop on where some of our understanding on the real world economy is coming through. If you look at the last few decades, before the pandemic, there is a switch. It alternates between the investment flow alternates between technology and real world economy or the old economy. And when I say this, if you look at the period between 80s through 90s, money flew, or there was larger investments that were made in old economy. From 90s to 2000, you had more investments going into the technology world, and you had the dot-com bubble. Then the money sort of started flowing back to the old economy. You had GFC at the end of 2010 or 2009. And then from 2009-10 onwards, which we call the easy money era, where the interest rates were really 0, 1%, etc., money started flowing back into the technology world. What is staggering here to see is, over time, and especially in the last decade, the amount of stimulus for one reason or the other, for the various black swan events, whether it was GFC, whether it was the pandemic, or anything else in between, has been 46% of the GDP. So you've come to the brim, and hence, each time there was a black swan event, from the peak to the bottom, you suddenly came back with the money that came by a stimulus. That's going to change, and the V gets replaced by a smiley, and perhaps it's a bit of a long grind, which again represents the old world economy, the manufacturing companies, the sector which is not core technology, although we may be writing codes for them in India, but this is the brick and mortar business that is going to drive demand for commercial real estate for the short to medium term. The other nuance is that the developed economies on this curve perhaps are on the left side, and India, for all the good measure, all the good reasons, is perhaps on the right side of the curve. So we are on that side, and given the fact that there is that whole work from home element still at play, if you were to sort of look at the various elements and then see where it stands, I think where you have higher return to work, where companies have been profitable, where the money flow is perhaps moving, one can argue to say that, especially in the last 2 or 3 months, there's a lot of money moving towards AI. And if you look back on what AI means, it's a lot of chips in consumption, but that is a hybrid of technology and manufacturing, whether it's NVIDIA, AMD, Lam Research, Applied Materials, etc. It's a mix of hardware and manufacturing at play. So it's again realigning to the real world economy. The other stat when we were doing a bit of research on this is the investments in the last decade in the real world economy at an average went down by 7% per annum. So you have over a 10-year period, a huge drawdown on money flowing in the old economy or the real world economy. But in 2023, you had a staggering jump of 240% money flowing back to the old economy. So to sum it up, on a broad basis, we will not have any new fiscal stimulus. We peaked out at 46% in the last decade as a percentage of GDP. This is a change in cycle, and we are all been awaiting in the recession. Perhaps there is no recession in play, but there's going to be far more prudence in decision making, spending and investments. I think from a commercial real estate standpoint in India, we will see volumes returning to 55 to 60 million square feet in the short to medium term, but it may be across many more deals. The average deal size is likely to reduce, and the driver for this would be India-facing businesses, again, which is the old economy or the real-world economy, and within the technology sector, it's going to be represented by the old economy for businesses that are out of North America and Europe. So that's our two-bit on where we see demand in India. Thank you very much. I will take the opportunity to thank Dr. Elliott and Tim for their time today.